starting the webinar. So just give everyone, it doesn't start for another 30 seconds, just give everyone time to get in.
Okay, everyone, good evening. My name is Paul Lynch and welcome to the quarterly investment review that we're doing here at Australian Catholic Super and Retirement Fund. I'm the Regional Manager for the Brisbane office, and tonight we've got two experts within our investment planning division presenting, John and Chris, who I will introduce in a moment. But tonight, let's start with a moment of reflection and welcome to country. I would like to acknowledge the traditional custodians of the land on which I work and live, and recognise their continuing connection to land, water and community. I pay respect to elders past, present and emerging. Thank you all very much for joining tonight. And with every financial services company that does a presentation like this, we need to remind people in regards to what we're presenting here tonight. Tonight, we're only producing or providing you with what we call general information or factual information on the portfolios that we offer. So tonight, Chris and John will be presenting information. Now, if you do require any further information in regards to the fund, I would encourage you to go to our website at www.catholicsuper.com.au. And if you require further information, our product disclosure statement or PDS and financial services guide is available there for you. So tonight, welcome to Chris and John. Now, for those people that have regularly attended our quarterly investment update, Chris has provided an update in terms of our investment markets. Chris has been with the fund since 2015 and is the investment manager of public markets. In his role, he manages the fund's equities portfolios. Prior to joining the fund, Chris has held senior investment roles at Sun Super and an energy industry super scheme of New South Wales. He holds a bachelor's degree with honours from the University of Wales in Swansea, UK, and a graduate diploma of applied finance from Kaplan Professional. In his spare time, which I'm pretty sure in the current investment world is probably limited, he enjoys a variety of sports and is an avid Liverpool FC fan. Chris lives in Sydney with his wife and 10-year-old son. Joining him today for our first time at our quarterly investment updates is John Fokos. John is our investment manager of private markets and has been with the fund since 2015. In his role, he manages the fund's bonds, credit, property and infrastructure portfolios. Prior to joining Australian Catholic Super, John spent 10 years as a senior investment role at WorkCover New South Wales. John is the holder of the right to use the Certified Chartered Financial Analyst designation from the CFA Institute. He holds a graduate diploma of applied finance and investment from the Securities Institute of Australia, which is now regarded as FINSIA, and combined bachelor's degree in science and education from the University of New South Wales. Wrong town there, John, sorry. John lives in Sydney with his wife and his 14 and 12-year-old sons and is trying to stay active through traditional karate. Today's session, we're obviously going through some information that John and Chris both feel as though it's relevant to our members. In tonight's webinar, it's recorded and is being streamed live on Facebook. Any of the attendees tonight, if you wish to ask a question, what I will do is that at the end of the session or the presentation from Chris and John, I will come back through the chat Q&A and the chat facility. And so if you've got any questions and you want them answered at the end of the session, please enter that through the facility on the Q&A or chat facility. It doesn't matter, I'm monitoring both during the presentation. Also, at the end of the presentation, I'll be providing you with an update on where you can gain further information from the fund. But for tonight, I get all the information from Chris. So tonight we hand over to Chris to provide the update on the current quarter. Thanks, Chris.
Thank you, Paul. So tonight we're going to run through a bit of an economic outlook, what we're seeing in financial markets at the moment. We're then going to run through how we've positioned our portfolio in light of that outlook. And then we'll run through some performance numbers. And we're going to finish up with a spotlight on fixed interest. Remember previously, for those of you who attended, we ran through how we look at Australian equities. This time, John's going to run through fixed income. So if I kick in, the overview of the world as we see it, it is, as Paul said, it keeps us occupied. There is a lot going on. These are unique times for everybody. And investing in this environment is difficult and unprecedented in many aspects. So at the highest level, COVID infections, I think we get a false sense of security being in Australia. Globally, infections are rising. That tends to be focused in countries like India and Brazil, where we're seeing peak numbers every single day. However, vaccinations have been rapid in those countries that need them. We'll see some charts shortly, but the UK in particular has handled their vaccination rollout extremely well. In light of that, governments are throwing unbelievable amounts of money at the economy. So you remember back in March when COVID first hit, we had JobKeeper, we've had JobSeeker, we've had in the US a $2 trillion stimulus plan. They're talking about another $2 trillion to spend on infrastructure. There is unbelievable amounts of money in the economy, and that's going to find its way somewhere. And so despite historically high valuations, we still remain cautiously optimistic on what's likely to be a record-breaking year for economic growth, in which equities generally do quite well. So just to give you some more detail on some of those points, this is looking at COVID-19. The chart on the left is looking at the weekly cases per region. So you can see the green line there is number of global cases, and you'll see it's updated to kind of the end of April, and we reached the peak, or we went through the prior peak, reached in December of 2020. So COVID is still rising, and you can see there the orange section, which is the Indian subcontinent, where cases really are rising and are getting out of control. But with every piece of bad news, we have good news. On the right-hand side, we have the number of vaccinations going out globally. And as I mentioned, the UK are leaders here. The US closely behind. Australia is the orange bar at the very bottom, which is barely recognizable versus the higher vaccinating countries. But at the same time, the need for the vaccination here has been less. So each country's handled it differently. Overall, we think there's enough evidence that suggests that vaccination rollout will continue and will help to curb the spread of COVID-19. As I mentioned, we've had some record levels of stimulus in the economy. People have called this wartime stimulus. And so I've got this chart here. It's looking at within the US, the amount of debt being issued by the government relative to the size of the economy, so the GDP. At the peak of that in World War II, at the end of World War II, was 120%. We've just got to 130%. So it really is being treated as a wartime event, and the stimulus measures to reinvigorate the economy, to get people back into work, to get some infrastructure building done. It's taken an extreme amount of money, but these numbers suggest that this money is finding its way into the real economy and will provide some economic growth. And as well as the economic growth, this chart here, which I'll just spend a bit of time on, there was a survey recently done. So as part of the $2 trillion of stimulus put into the US economy, around half of that is going to find its way to individuals. So part of that stimulus package is giving each individual in the US a check for $1,400. Most of you might remember Kevin Rudd's GFC stimulus package, which gave everybody $900 to spend as they see fit. This has been $1,400 US to all Americans, on top of an already highly cashed society. So throughout COVID, people are staying at home, spending less. The amount of cash within household budget, so that's the amount of cash people are holding at home across the whole economy, got to $1 trillion. And we've just given them another $1 trillion. These are unbelievable amounts of money. So it's $2 trillion in cash waiting there. Where's this money going to go, is what this survey asked. And depending on the cohort, so you can see that, based on income levels, if you're earning $100,000 plus, 43% of that $2 trillion could find its way into the equity market. That's a lot of money chasing already high returns. But with that level of, that wall of cash that we've got coming, we think it supports equity markets for a reasonable time frame. I mentioned before as well, equity markets are expensive. However, given what we've just said, potentially there's a reason for that. And in light of extraordinarily low cash rates, which you would see in the economy, and the government bond yields, which are being issued at record lows, and John will talk through a lot of that later. We think higher valuations can be partly justified at the moment, and the amount of stimulus in the economy further justifies high valuations. So generally speaking, you don't want to buy things when they're highly valued. You can see here, this chart shows you the valuation of the US market going back to 1900. There's been a couple of times in history where it's peaked at particularly high levels. So at the end of the 1920s, we went into a euphoric state at the end of that decade, and then followed it with the Great Depression, which many of you may know from history. And the other time where we have any type of precedence to what's going on now was the tech boom of the early 2000s. These are very rare events. They tend to end in losses, but you can see there we're not quite at the levels of tech valuations, and you have to put this in the context of the current climate, which, as we've just shown, is unprecedented. We have ultra low cash rates, ultra low bond rates, meaning you don't want to buy bonds and you don't want to hold cash. And we have a highly cashed up retail investor ready to put money into the market. So even though valuations are expensive, we think there is some justification to be cautiously optimistic towards the equity markets. So what are we doing for your portfolios in light of what we're seeing in the world? To start with, just to reiterate our goal of what are we trying to achieve, and our goal is always to achieve the best returns we can within a risk-controlled environment. So we are not looking to expose any of our members to undue risk. We are looking at generating the best return we can after accounting for the level of risk we think is appropriate to take. What that looks like specifically at the moment is a modestly higher growth portfolio than our neutral position. So what you'll see in our investment fact sheet is what our neutral position is, which you'll see as our strategic asset allocation. We have slightly more equities than what we show in that, and we have less government bonds and less cash. Going back to our outlook on the world, bonds and cash have reached all-time lows. They do not provide us with good returns looking forward, and don't think we're compensated for any type of risk there. And so we've added to equities and corporate credit, which again, John will talk to soon. But corporate credit is essentially lending to companies rather than lending to governments. The charts we also showed tended to focus on the US market, and the US market is where we've seen a lot of those highly priced shares. We think we can find other areas of the world where we can still hold equities, so we can still maintain a reasonable level of risk in the portfolio that doesn't involve buying overpriced securities. The Australian market, whilst we're Australian investors and the rest of the world looks at us and say, are you only investing in Australia because you're in Australia? The counter to that is, at the moment, the Australian market is very attractive relative to US markets. It tends to, banks and resources within this climate offer reasonable prospective returns, and so we've tilted towards Australian equities and also emerging market equities, which means investing in the developing world, where again you're not paying those overly priced shares that you get in the US. And then, in order to maintain some protection in the portfolio, generally speaking, we would hold government bonds against equities to provide some protection. Given government bonds do not offer us that protection and that return profile that we need, we have increased our exposure to US dollars, which tend to do well in a downturn. And you would have seen that in March last year when the market fell 30% in a very short space of time. The Australian dollar fell around 11% against the US dollar. So when we bring everything back into Australian dollars, we get a currency boost by investing in US dollars. And so that protects our portfolios in the event of a downturn. So what does all this mean for performance of the portfolios? Putting it frankly, we're performing very well. So all of our diversified options are ahead of their objectives over 10 years. So we are, whilst we're doing a quarterly update, and we will talk about some of the shorter term returns, we are long-term investors, investing your superannuation and pension money for the long term. And so we're always looking at, you know, five plus years out to 10 years, which is our stated objective. And so to be achieving our objectives over that period is pleasing. Over the shorter term, you'll probably see it in your account balances. There has been an extraordinary recovery, and we'll see some of those numbers very shortly. The past 12 months, we've seen almost record returns from some asset classes and across our diversified options as well. So just to highlight a couple of options there, the Australian shares option is ranked number 2 out of the largest 50 superannuation funds who are offering Australian shares over the last 12 months. And our bonds option is ranked number 1 over 3 and 5 years against other diversified fixed interest options. So yeah, we do like to see how we're going against other funds, and that's a good barometer that we can show there. To run through some numbers, this is for our members in default, which you'll see as lifetime 1. And I think that, I mean, the history will come. It starts, so we have history beginning on the 1st of May 2018. So very soon we'll have 3-year numbers, and by the next quarterly investment review, you will see longer term returns. Right now, there you can see the 1-year returns have been pleasing. I think the important thing to note here is not just the absolute returns that we generated, but the profile with which we generated those returns. So lifetime 1 is positioned so that our younger members have higher risk and our older members approaching retirement have lower risk. We do that because we know that as members approach retirement, they can't afford large drawdowns, particularly when their contributions at some stage will stop. So during the COVID downturn, whilst equity markets fell, upwards of 30%, lifetime prime at its maximum loss was down around 3%. And so we really protected the capital of those members approaching retirement. And 1 year on from there, we've been able to generate 10% plus returns for those older members. And our younger members who did suffer bigger drawdowns, they're contributing, they have an extremely long investment horizon, and they've been able to compound higher returns by having that higher risk profile. This is to run through some of our diversified options. There's a lot of numbers on this chart, but I'll just highlight a few. And again, we want to focus on the longer term returns. So our balanced option, which is of our diversified options, our flagship, you can see it's generated a very stable 8% over 3, 5, 7, 10 years. And then just had the short-term kick in the COVID recovery. So these really are the type of return profiles that we like to see. Consistency in returns. We like to see 10-year numbers obviously above their objectives and delivering strong risk-adjusted returns for our members. Just running through a few more here. Even our capital stable, which is our lowest risk diversified option, has made, it depends on whether you're in super or pension, so that's whether it's taxed or not, but made between 4 and 5% over 10 years. So that's per annum over 10 years, which if you're a low risk investor, that is a great return when this option is only trying to achieve 1.5% over inflation. To highlight some of the single sector options, we mentioned Australian shares as being a top 3 performer in the top 2 performer in the market over the last year. You can see here the type of returns which we do not expect to continue. 46% over a year is spectacular, but yeah, don't expect it to continue, and we are obviously watching that. We're changing the configuration of the Australian shares portfolio in light of those excellent returns. I think it's worthwhile as well, moving down to the bottom of this table. We have communicated that we expect cash returns and bond returns to decrease from what we've had historically. And you can see here, if we look at the cash returns, historically you might have received between 2 and 3% returns, and that's the realized returns over 10 years. Over the last year, cash has returned 0.3%. After inflation, that's negative. And so this is part of our thesis for why the current environment favors equities over cash, is because cash is just not offering you any type of return. Similarly for bonds as well, we have the bond option here between 4 and 5% long term, and between 2 and 3% short term. And with that, we expect that to trend downwards as well, offering very little return after inflation. And so with that, I'm going to hand over to John, who's going to talk about our fixed interest investments.
Thanks, Chris. So when we look at fixed interest, or when we talk about fixed interest, when we use terms like fixed interest or fixed income or credit or debt, and these terms are all synonymous. They all mean roughly the same thing, and they're all just a fancy way of saying lending. What are we doing with all of this fixed interest, credit, debt, fixed income? We're lending money. So it's different to equities or shares, where you're participating in the ownership stake of a company and you're expecting a return, part profits in that company's profits. So there's upside potential in your investment. when you're lending, all you can hope for is an interest rate that you charge for lending and your money back at the end of the day when the money is due. We'll call that the maturity of when you lend. So it's a different dynamic than equities or shares. So the interest rate or the yield that you set for lending your money is going to be sort of taking into account all sorts of risks that you're taking on in that lending activity. And if there's the risks that are considered are credit risk. And what we mean by that is what's the likelihood and the ability of who you're lending the money to repay the money and pay your interest when it's due. Whether the debt that you've got at the end of the day, if it's a security, whether you can trade it, sell it to someone else. So that's a form of liquidity. Or maybe the way you've lent it is a private arrangement, and you just lending it to an entity, and it's not a traded security that you can sell to someone else. You're holding that piece of debt for the duration. It might be for 5 years, it might be for 10 years, but you basically hold that debt, if you like, and it's totally illiquid. So you might want to get paid a little bit more for that illiquidity. It might be that who you're lending to is putting up some form of security in terms of the assets of the company, or if it's a government, they're not going to put up security. It's a government they can tax, so there's no security involved. If it's a corporate, you might be lending on an unsecured basis, but you might be lending on a secured basis, which means if they default and they don't pay you, you have some security in terms of their assets that you can have a claim on. So these are some of the factors that go into what interest rate is arranged when you lend. And there's some other ones like complexity risk. So if the debt arrangement or the lending arrangement is quite complex, you might be asking for a little bit more in interest rate. There's one other risk which may not be referenced in the interest rate, and that's funnily enough, the interest rate risk. And this is what Chris was alluding to earlier. When you've got monetary policy, as we've seen today with the Reserve Bank and other central banks around the world, putting rates down effectively, their overnight cash rates, we can see that that's down to 0.1. And they've got all sorts of arrangements that you might have heard of, things like quantitative easing, and there are other programs that the central banks run that are really reducing the cost of borrowing for our governments, be they the whole federal government, Commonwealth government, or the state governments, and even our banks. Then what tends to happen is they tend to borrow money for longer and longer periods out, so a longer horizon. And what tends to happen then is you have something called interest rate sensitivity. Just as an example, government bonds today, let's say if they had a interest rate sensitivity of 6 years, that might mean that if interest rates rose by 1%, then the value of the bonds might actually go down 6%. So that's counterintuitive, but that's just the way it works. And so Chris mentioned earlier that we don't really favour bonds at the moment, and that's partly due to the low interest rate that we can get from them, and it's below the rate of inflation or the forecast rate of inflation. So we don't want to have a negative return after inflation, but it's also because there's a substantial amount of interest rate risk to the downside if rates start to climb up. We saw a little bit of that in the December to February period recently, where rates sort of went up, not the cash rate, but longer dated rates went up, and this led to our fixed income markets or bonds coming off a little bit in return. And we saw our bonds option provide a small negative return, which over 1 year it's not negative, but just over those couple of months, some of our members picked up that it was a negative return. So we compartmentalize our investments in credit and fixed interest, rather, in three main lines or three main groupings. The first one is bonds, which we just talked about, with the interest rate risk. which we offer as a standalone investment as well as feeding into our diversified options. Credit income, which is a newer option as well. We've offered that since 1 July of 2017. So it's coming up towards its four-year anniversary. And yes, that's offered as a standalone investment option on our investment menu, but also our diversified options have an allocation to that. And fixed interest alternatives, which is also similar to credit income, but slightly higher risk and return accordingly. That's not offered as a separate investment option, but it is part of our diversified options. So what's the main differences here between, say, bonds and the others? Well, what are the features first? So with bonds, we're lending primarily to governments and Commonwealth government, state governments, and a little bit to the banks. There is that interest rate sensitivity that we spoke about. It's primarily, very much investment grade. The Australian Commonwealth government is rated AAA by Standard & Poor's, as an example. It's very liquid, so we can always call on that money and sell those bonds in the market to realise some cash to invest elsewhere if need be at a critical point in time. Credit income is somewhat different. It doesn't have that interest rate risk. It's just based off the short-dated cash return. Though, think about the overnight cash rate of 0.1%. It doesn't matter if interest rates move up or down. Its returns not really going to be sensitive like bonds are. And in fact, if interest rates go up, the credit income, short duration credit, as we'd like to call them, those returns should go up over time if interest rates are going up rather than down like bonds might go. And these are primarily unsecured loans to banks and public and private companies, sometimes to emerging markets, both other governments around the world in the emerging markets and the companies in those markets. And sometimes it relates to secured lending. So these are illiquid investments. We'd like to find creditworthy companies that we'd like to lend to, and we expect a slightly higher rate of return than if we're lending, obviously, to our banks and governments. That's the same with fixed interest alternatives, but as we say, that's a little bit more risk in order to eke out a little bit more return. Now, the difference with credit income is we're trying just to make you a 2.5% return above cash or bank bills, even after tax, let's say 15% tax, that super's normally taxed at, and fees. So we're not trying to make too much, but we want to make something that's meaningful, that's obviously improved on what our forecast is for the cash return after tax and fees and after inflation, which we don't favour that return. So cash is going to protect your capital potentially, but you're not going to take any risk and you're not going to get any return. And you're certainly going to go backwards, I'd say, after inflation. I'll just talk a little bit about credit income versus cash, a little bit more on that. Just looking at credit income's 2-year return, we've got 3.93% after tax and fees, and it's 3.34% for the financial year to date. And that's certainly meeting that objective of trying to make that 2.5% above cash or bank bills after tax and fees. Now, it did drop, the returns did drop through COVID, just so that you know you're taking some credit risk, as we talked about earlier, and that came through in the performance, which dropped about 1.6% from its peak to its trough. So from the top to the bottom through COVID, dropped about 1.6%. Of course, cash did nothing of the sort because our cash option is just accruing interest as the money is placed in term deposits and bank accounts, and never really goes backwards at all. But for a little bit of, or a modest amount of credit risk, we think you can make that 2.5% return but you must be able to bear a little bit of that volatility like we experienced through COVID in order to get that expected return. Back over to you, Chris.
I think that pretty much sums up the investment overview. It's time to hand back over to Paul, who will just sum up, and then we'll take some questions, hopefully, from the audience.
Thanks, Chris and John. Before we do start, if you do have any questions, you're more than welcome to push them through the Q&A section or the chat facility within this forum. So if you wish to ask any questions of John or Chris, we can certainly come and field those in a moment. Before we continue, I just thought I'd highlight there is a fair amount of important information contained within our portfolios. If you do want further information, all of these details are actually contained on our website. So I would refer you to our website in terms of these details, in terms of when portfolios started and commenced and the like. So more than happy for you to seek that information through the website. In terms of tonight's session, Justin Colley, our Business Development Manager in our Sydney office, is going to place a link if you wish to gain further information from the fund. So he certainly will be placing that in the facility soon, and I think he has done so now. So in terms of that, if you wish to gain further information from the fund, so you can have the right to have a general information discussion. Now that can be with a regional manager in your local area or a call centre staff. And we're more than happy to discuss with you information or questions that you have in regards to our portfolio. The one thing that I remind people of is that we cannot provide advice or recommendation. We can just send you the details of what these portfolios contain. If you wish to complete forms, assistance with our website, or our projector tool that we utilise within the fund called Raptor. So if you do wish to have further information, contact the Fund There IO 1300 number, or otherwise on the link, click that you wish to have a chat, and someone from our organisation will give you a call in the next week, within the next few days. In terms of advice offerings, we do have two options available to you. So tonight we've been talking about investment options, and the one thing that I can say is that we do offer an over-the-phone advice service. Now, if you wish to seek some advice in terms of which portfolio suits your style, remember, no one can tell you which is going to be the best portfolio over the next year. That's simply not possible. And I'm pretty sure if someone can do that, they're probably not sitting at our organisation. They're sitting somewhere in a luxurious holiday destination. Certainly the one thing that I would say to people is that over the phone advice service, it's at no further cost to you. They can sit down, ask you some simplistic questions in regards to your investment option, and then they can come back and provide you with an idea of what style of an investor you are. Now, that style of an investor is more for the long term. So I would recommend that you can do that with the fund. It takes about 30 minutes of your time to run through the investment advice section. So certainly that is available there. Remember, at no further cost. By clicking on the link that you wish to have that limited advice, someone will give you a call to arrange a time to suit you to have that investment option with one of the team. Obviously, if you wish to contribute more or assist with salary sacrificing, those available options are there. Now, our comprehensive advice service is where you meet face-to-face with our advisor team. Now, you can meet with them face-to-face with yourself, and if you have a partner, you're more than welcome to bring them along. And that really is where they sit down and look at strategically where you are wanting to go to. They sit down and look at your goals. They look at and provide you with a strategy in order to achieve those. Now, this does come at a cost, and it's what we call an fee for service. So certainly they will sit down with you and look at all of your options in terms of your strategy and provide you with a quote at the end of the first appointment. Now, that quote, I always tell the people that go to that facility is that they're only going to provide you advice if there is a benefit or a net gain for you. So it's certainly something that differs to out there in the marketplace. Our facility or our option for this comprehensive advice, I think, is quite a good option to assist members because they're going to give you a blueprint, a very detailed document that details where you're heading, and that will include where it is, which style of an investor and where you should place your funds. It'll look at cash flow, could look at debt management, could look at retirement planning. So there's a number of different options available. Obviously, if you're looking at estate planning and advice around non-super investments, that is all there. So it really depends on your personal situation and where they can best tailor to suit your needs in terms of advice. So again, if you wish to have a comprehensive advisor, again, someone will give you a call to arrange an appointment with one of our advisors within that area. In terms of that, if you wish to have further information, the 1300 number is there. So Chris and John, I will now turn to a couple of questions that we have. I'm very mindful of time, so that we may not be able to get to a few of these, but we'll certainly try. On the single sector options, can you explain why the property portfolio performs so poorly? I think that would be for you, Chris.
John will take that one.
John will take that one. Good. Thanks, John.
Sure. So through COVID, what we saw was that we were placed under restrictions. People didn't have the same confidence to go out and about, whether it was to work, to get to commute to work, and certainly in terms of going to the shopping centre and conducting their usual shopping habits. And what we found was, whilst Woolies and Coles and Aldi, all these supermarkets were doing fine in terms of their trade, not so very, the retailers outside of that fared unwell in relative terms. And in fact, many of them couldn't even pay their rents, their leases to the landlords, primarily the shopping centres as landlords. And in fact, we would have seen quite a bit of support provided by the government. We've seen, Chris has talked about JobKeeper, JobSeeker. So there was a lot of support. And in fact, the government even mandated that there needed to be some rent relief for tenants. And this also affected retailers in shopping centres. So we saw a lot of the rental come down for shopping centres primarily, less so for office, and certainly not for industrial. And this has led to valuations for these property assets, primarily the shopping centres, to come down. And this has fed to a negative return for our property option. It is not unusual. We've seen, it's expected, it's not unanticipated. And the 1 year number that we've got there as a negative return that we've seen on the screen earlier, that includes the valuation hit arising from COVID. And so that April return will roll off in another month, and you'll see that 1 year return pop up again. Of course, that negative return will be embedded in the 2 years return, but you'll see greater stability over the 2 year return and onwards going forward, hopefully, with all of us now having more usual shopping patterns and behaviours.
Thanks, John. Chris, this might be one for you. So we've got Peter asking, if I change my investment category, do I have my own discrete pie in that category, or do I have a larger part of the pie with all the other members in that same category?
Okay. Yes. So when you choose any of our options, you are invested alongside all of the members who've chosen that same option. So one of the primary benefits of a superannuation fund is that we can pool investments and pool all the contributions from all of our members and get scale benefits and fee discounts and buy stuff that we couldn't do if you were just doing it yourself. So John's talked about property just then, like when we pool an individual can't go and buy a shopping centre. When we pool everybody together, we can buy a shopping centre. So we gain scale benefits by pooling all the members within an option into a big pool and invest that pool.
Lovely. Thanks, Chris. We've got a question here from Rod, and I'm actually intrigued to hear your answer here as well. What is our policy on investing in Bitcoin and similar platforms?
Look, the short answer is we don't invest in Bitcoin. The main issue, I think, each of us in the investment team has a slightly different view. I would say the overarching view is there is no way of valuing Bitcoin. So if it's whatever it is, $60,000 today, is that cheap, expensive, fair value? We don't know, because there is nothing behind it. It doesn't produce cash flows. It has no productive value to it. So how do we value it? And if we can't value something, then we can't buy it, because we need to know that there's a reasonable expected return from it. So yes, at this stage, it's no to Bitcoin. And obviously with that is all other cryptos and the likes.
Lovely. And I think Veronica has just posted a message saying that it's good to hear that there's no investment in Bitcoin. So, and I share that sentiment. John, I've got a question here. Is there a risk that companies still go broke with the borrowing costs so low and with so much support there with banks and governments?
That's a really good question. So the risk of default is being considered as coming down, but then as you've said, that has come courtesy of a lot of support come from governments both here and abroad, and you might have even heard that the Federal Reserve in the United States even started buying on the periphery, started buying high yield bond exchange traded funds, which all of this serves to provide a safety net or a support to, I guess, corporations who have borrowed money. So from that basis, there's less risk, but at the same time, without that support, a lot of companies would be potentially going bankrupt. So it's a very difficult situation. And to top it off, the return or the forecast return that you can see in the marketplace for lending to corporates is really quite low. And so for what we would call in the old days junk bonds, or what we now call high yield bonds, so lending to very risky companies in terms of the risk that they may not repay you, that return is really historically very, very low. So it's a conundrum in terms of investing or lending rather to corporates. I don't think the risk of bankruptcy has gone. You just have to be cognizant that corporates are being supported at the moment, and just being mindful of that when we do lend.
Lovely. Thanks, John. With the amount of time that we've got, I might make this the last question. So Peter's just come in with, does the concept of modern money theory play a part in the fund's decisions with regards to investments?
Yes, I mean, so I might run through modern monetary theory. Effectively, John, you can step in as well, but effectively MMT, as we call it, modern monetary theory, says that the government can issue as much debt as it wants because it's in control of its currency, and use that debt to support economies. We've seen some evidence of that happening, and we've run through some of that. So I ran through the chart before, which I'll just pull up now, on the level of debt within the economy. The government's clearly saying we are happy to issue a lot of debt. A vast proportion of that debt is going to find its way into financial markets, which is where we generate returns from. And at some point in time, that has to come to an end. You can't issue debt forever. But in the meantime, there's an old saying, don't fight the Fed. The Fed is the one pushing interest rates down, pushing longer term interest rates down as well, forcing you into these, forcing you into riskier investments. And so, yeah, we take all of that into consideration and say at the moment, the governments and monetary policy is forcing you into risk assets.
Yeah, this is a very, very in-depth topic that deserves a lot more than say 5 minutes, but I don't think we can do it justice in less than 5 minutes. But effectively, the big difference here is that just like we talked about with corporates being supported by government policy and the central bank policy, we fundamentally have got national governments, countries, in terms of their borrowing, being supported by their central banks. In some ways, it's being viewed as using the printing presses to supply more money, in which case the question is, why go out seeking capital in terms of borrowing from entities like ourselves on your behalf? This is a very difficult situation again, because this is in some ways taking away the free market component of what has traditionally been a free market, where the borrowers and the lenders meet at some point in the free market to determine the price of what that borrowing, what price that borrowing should come at. And in some ways, this price discovery is what we call it. It's being distorted. So it's a very difficult investment market to navigate. So we're very cautious at the moment.
For sure. Thank you very much for that, John. Thank you very much, Chris, for joining us tonight and providing the update and sharing your infinite wisdom in regards to investments at the moment. So thank you very much, and we appreciate it from the members of the fund. Thank you again for your attendance at tonight's session. All the people that are watching via this stream, whether it be on Facebook or through the link that you received. Again, you will be receiving a survey tonight. If you wish to complete that, we would greatly appreciate and provide us with updates for any future investment updates that we provide. You will also have the opportunity that if you wish to seek further information in regards to the fund, that you will be able to do that as well. Again, thank you all very much for joining tonight. Have a wonderful evening and hopefully speak to you soon. Thank you.
Thank you.
Thanks.